Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.
The bottom chart here is a picture of the euro versus the U.S. dollar, okay? And again, we're looking at this correlation. You notice something here. As soon as this started breaking back in November, down, meaning the spread widened, what did the euro do? The euro started to take that hit right in December. When did it start improving? Right here, December 21st. When did the euro start to rally? December 22nd. Pretty tight correlation. What is interesting also is gold actually moved in this exact same pattern. Gold broke down on this risk with the euro. Gold did not play its role as a safe haven, which tells us there's a liquidity game going on here again. That's a whole other thing we put in our pocket to think about, and I'll explain that going forward. Sure enough, Greece, of course, tells everybody everything's hunky-dory, is fine. We're going to improve our budget deficit. So the spread starts to come back again, and the euro comes back. And there's the euro here around 146. We sent this out to our clients. It was 145 and change, I guess, on the 12th. Said something to watch. This spread started to break down. The euro is just starting here. We thought the euro, if the spread continued down, the euro would break, but it's lagging a bit here. So it was something we were watching very, very closely for a trade setup. So, of course, we put on a trade just to stop in here that if it comes back through, we thought it would follow through. This whole Greek problem continues to be a problem. We find out that they're lying about their information. No surprise there. Governments lie all the time. But what's interesting is the austerity that the European Commission or the European Eurozone is trying to put on Greece. It's a big problem because Greece has a lot of socialists and a lot of labor unions that aren't going to stand for it. So the European Union basically is in a box. If they bail out Greece, it's moral hazard for the other countries to do this. If they don't bail out Greece, the political risk soars in Greece. This spread widens. It means it costs Greece more to borrow, so they won't be able to close that budget gap. So it's a catch-22 either way in here. And because of the background of the credit crunch and the pressure, this first-time pressure on the euro, we expected this to be a real problem for the euro, and it looks like it's turning out to be. But this is the setup that we were watching closely. This move down and this tight correlation with the euro, the move back up, euro followed, and this started to lead again. And this is that chart we looked at with gold. And remember, as I said earlier, gold and the dollar are usually very, very tightly correlated. They have been of late. And this was that move, back up in October when everything, was kind of hunky-dory. Everything moved back up. Gold moved up. The euro moved back up. I'm sorry. This is that area where the pressure came in. Things looked better. As Greece said, okay, we're okay. Gold came down, bottomed the same day. So you're seeing some pretty tight correlations here. We know gold and the dollars are tight. We know euro is kind of the flip side here, and we know what euro is moving on is Greece. But as I said earlier, what's interesting about this move in gold, the risk came into the world that hurt the euro. This idea of Greece, and we also had Dubai in the background too, adding to this. So if gold is supposed to play this role that everybody says it's playing now of safe haven, it didn't do it. That's another piece of the puzzle. That, again, as I said earlier, you want to think about this stuff. You just don't want to look, mechanical. What does that tell us a little bit? We talked about these different categories of risk appetite, risk aversion. When gold doesn't move up, when risk comes into the world and risk aversion, or when it moves down in risk aversion, as done today on a lot of risk in the world, we know that it was bid up on this. It was bid up on liquidity flow. That tells us also that the liquidity flow is driving some of these correlations. So it just adds to the idea that if risk comes into the world, the usual correlations of buy the dollar, sell the stocks, buy the bonds, sell commodities is going to play out, and that's exactly what happened, and that was supported in this. I know that sounded a bit esoteric, but that was, again, just part of the piece of the puzzle. When you look at these things, just think all the time. So sure enough, Euro's tumbled. This is from today, I guess. This chart is from euro from today. Gold tumbled down, Euro's tumbled down because that spread is actually, if we look at this spread, it actually came here. The euro was still up in this range. It came all the way down. The spread widened even more today, and the euro plunged and started to play catch up to that spread of that correlation. Gold doing the same thing. Stocks moving down. Stocks supporting the idea that gold is had played a liquidity role in this latest move as opposed to a safe haven role. So that's an important part of the puzzle, at least to us, that said these correlations are going to remain intact. Gold down, stocks down, dollar up, bonds up, and we're seeing it, kind of the classic risk appetite, risk aversion. Again, keep in mind that the dates and some of this things that happened. In the idea if gold was a liquidity move, then it would move down with stocks. We were watching stocks, and this is another correlation that we watch. Obviously, it's a lot that others watch, but we saw a fairly narrow wedge starting to develop in here. We got to move, out of this wedge, but we saw VIX, or the volatility index, coming down into territories, where people were getting very, very complacent. So we were watching stocks closely to give us a, kind of an idea of a setup in here of what could happen to the dollar. Again, we're thinking stocks down, dollar up on this move. We're back into more, at least in the near-term time frame, more of a classic risk appetite, risk aversion. Gold told us that, as I just said. So we were watching stocks and the VIX, of course. Everybody's complacent, fat, dumb, and happy again. Now, this is everything put together that we watch pretty closely every day, and you can see how these move. Again, this is a little messy. Let me go through this. Black line is Shanghai, okay, stocks, China's stock market. Red line is U.S. dollar index. Green line is CRB, or commodities index. And purple line there is gold. Now, the driver really, and I think everybody knows this, really is China. So we watch China pretty closely, the news out of China. We can't watch the Chinese currency because it doesn't move. It's pegged to the U.S. dollar. So we have to watch the stock market and just watch the news per se. Again, China had some very, very good news of late. Industrial production up again, GDP up again. Just a lot of good news was coming out the last couple of weeks. So you're thinking all this good news, we got the U.S. stock market, coming in, making new highs, and the place where all the good news is coming from, China, guess what? They aren't making a new high on all this good news. Again, you're thinking about this stuff. It's not happening. All this good news out of China, guess what? The CRB is not making a new high, and it's starting to break a bit. Gold, of course, we saw gold earlier lacking the safe haven role when we looked at it in a tighter correlation, obviously in the last chart with the euro. And here's the dollar, and the dollar actually, kind of doing very well, even with, some of the moves, the correlations changing, the dollar's getting some support in here. If you looked at gold, the gold price against the U.S. dollar, you started to see you started to see really a bit of a breakdown in the correlation earlier on. I don't know how to explain that, but when we look at gold and some of the price in some of the other currencies, you could see that this move in the U.S. dollar, when it broke and gold went up, was not just a dollar move. It was a weakness across the whole class of currencies as opposed to just the U.S. dollar, where in the last cycle, whenever the gold went up, it was more or less a dollar fear move. But because the dollar didn't make a new low when gold made a new high, it told us that this move was not purely dollar related. Again, you're thinking about that. In the past, whenever gold made a new high, the dollar made a new low. It didn't happen this time.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.